Pull up the list of the 500 largest public companies in the United States. Apple, ExxonMobil, JP Morgan, Coca-Cola, Boeing, Delta, Ford, companies that compete against each other, sue each other, and lobby against each other. Now ask a simple question. Who is the largest single shareholder of each one? The answer, in the overwhelming majority of cases, is not a founder, a family, or a sovereign fund. It is one of three firms: BlackRock, Vanguard, State Street. Most people have never bought a share from any of them on purpose. Yet if you hold a retirement account, a pension, or a target date fund, you have almost certainly handed one of these three the right to speak for your money. They do not run the factories. They do not design the phones. They own slices of nearly everything, quietly, at a scale that would have been unthinkable a generation ago. A single share here, a fractional stake there, multiplied across thousands of companies and hundreds of millions of accounts until the fragments add up to a position no rival can match. The ownership is invisible precisely because it is everywhere at once. Together, these three firms manage more than $25 trillion. That is larger than the annual output of the United States economy. It is larger than the combined stock markets of most continents. And unlike an oil giant or a bank, they built this position without selling a single physical product. They sold something simpler: the idea that you should stop trying to beat the market and just buy all of it. Here is the tension this video will follow. The money is not theirs. It belongs to teachers, nurses, retirees, and ordinary savers. But the votes attached to that money are theirs to cast. When a shareholder meeting decides who sits on a board, how much a chief executive earns, or whether a company changes course, three firms in Manhattan, Pennsylvania, and Boston hold a block of votes larger than any rival. Ownership was scattered across millions of people. Control was funneled into three switchboards. None of this is a secret, and none of it began as a plot. It is the logical endpoint of a very good idea that worked far better than anyone predicted. To understand how three companies came to sit atop the American economy, you have to start not with power, but with a frustrated professor and a simple, almost boring insight about the stock market. For most of the 20th century, investing meant hiring an expert. You paid a fund manager to pick winners, dodge losers, and beat the market average. The pitch was seductive, and the fees were high. There was only one problem, and academics kept pointing it out. Most managers, most years, failed to beat the simple average they charged so much to outperform. In 1976, a former mutual fund executive named John Bogle acted on that insight. He launched a fund that made no attempt to pick winners at all. It simply bought every company in the S&P 500 index in proportion to its size and held them. No star manager, no stock picking, almost no fees. Wall Street mocked it as un-American, a guarantee of mediocrity. Bogle called it the index fund, and it became the foundation of Vanguard. Its formal name was the First Index Investment Trust, and skeptics nicknamed it Bogle's Folly, certain that no serious investor would settle for merely average returns. The launch raised a fraction of what its backers had hoped, and for a while, it looked like a costly embarrassment. The logic was hard to argue with. If the average professional cannot beat the market, then paying high fees to try is a losing bet over time. Buy the whole market cheaply, hold it for decades, and you keep the returns that fees would otherwise erode. Compounded over a working life, the difference between a fee of 1% and a fee of a few hundredths of a percent is enormous. It is often the difference between retiring comfortably and not. Over a 40-year career, fees skimmed each year quietly consume a large share of the final nest egg, which is why a product that charged almost nothing was, for the saver, close to a free gift. The math was not exciting, but it was undefeated. For years, the idea grew slowly. Then, it became a stampede. Investors pulled money out of expensive active funds and poured it into cheap index funds that tracked the market automatically. The flows were not millions, but trillions. By the mid-2020s, passive index strategies had overtaken active management as the home of most American fund money. The mockery had reversed. The boring idea had won. But every idea carries a consequence its inventor did not intend. Index funds do not choose which companies to own. They own all of them, forever, by design. As trillions flowed into these funds, The firms running them were forced to become permanent, growing shareholders in every major company at once. Bogle spent his final years warning about exactly this outcome. The tool built to democratize investing was quietly concentrating ownership into a handful of hands, and three firms captured almost the entire wave. The three did not arrive by the same route, and the differences matter. BlackRock is the youngest and the largest. It was founded in 1988 by Larry Fink and a small group of partners, originally as a bond-focused shop, obsessed with one thing: measuring risk. For 2 decades, it grew steadily. Then, in 2009, in the wreckage of the financial crisis, it bought Barclays Global Investors, the owner of the iShares exchange-traded fund business. The deal was worth roughly $13.5 billion, and it delivered iShares, then the fastest-growing corner of the fund industry. Overnight, BlackRock became the largest asset manager on Earth, a title it has never given up. Today, it manages well over $11 trillion, a sum that has continued climbing toward figures once reserved for entire national economies.
Vanguard took the opposite path. It does not chase acquisitions, and it does not answer to outside shareholders. Because of the structure Bogle designed, Vanguard is owned by its own funds, which means it is effectively owned by its investors. That mutual structure lets it push fees relentlessly toward zero, because there are no outside owners demanding a profit margin. The result is a firm that manages roughly $12 trillion and grows almost automatically, one paycheck contribution at a time. There is no marketing genius required, and no acquisition to negotiate. As long as ordinary Americans keep saving into retirement plans, and as long as those plans keep defaulting into index funds, Vanguard's stake in corporate America keeps rising by itself.
State Street is the oldest presence and the smallest of the three, but it holds a historic claim. In 1993, it launched the first American exchange-traded fund, tracking the S&P 500, still known by its ticker, SPY. That single product opened the door to the entire ETF era. State Street manages several $1 trillion today, less than its two rivals, but enough to complete the trio that dominates index investing. What unites them is not strategy, but position. Each runs enormous funds that must, by their rules, hold every large public company. When you own the whole market, and the market keeps growing, your stake in every individual company grows with it. There is no decision to buy more Apple or more Exxon. The buying is mechanical, driven by every automatic contribution flowing into every index fund, every payday across the country. That mechanical quality is the key to everything that follows. These firms did not set out to control corporate America. They set out to sell cheap, sensible funds to ordinary savers, and they were extraordinarily good at it. But scale has its own gravity. When three firms sit at the top of nearly every shareholder register in the country, their combined position stops being a collection of small stakes and starts being something closer to a block. The next question is exactly how large that block has become.
Numbers make the abstraction real. Two Harvard-affiliated scholars, Lucian Bebchuk and Scott Hurst, have tracked the combined ownership of the three firms in the S&P 500 for years. Their finding is stark. In 2008, the three together held about 13.5% of the average large American company. By 2023, that combined stake had climbed past 22%. The line goes up steadily, year after year, with no natural ceiling in sight. 22% may not sound like control. No single firm holds a majority, and none can dictate outcomes alone. But in a public company, shares are scattered across thousands of holders, most of whom own tiny fractions and never vote. Against that fragmented backdrop, a block of 1/5 is not just large, it is usually the largest by a wide margin. In hundreds of S&P 500 companies, the three firms together hold more than 20% of the stock. By one count drawn from the same research, that threshold is crossed at over 400 of the 500 largest firms, which is another way of saying it is the rule, not the exception. Being the biggest owner of one giant company is notable. Being the biggest owner of most of them at once is a different category of fact. Concentration compounds when you look at who actually turns up to vote. Small investors rarely cast ballots at shareholder meetings. Index funds always do, because they are required to. So the effective voting power of the three is larger than their ownership share suggests. Bebchuk and Hearst estimate that the three cast, on average, around a quarter of the votes at S&P 500 companies. 1 vote in 4 at nearly every major company in the country flows through 3 institutions.
Consider what that means at a single company. A board wants to fend off an activist investor pushing for change. A quarter of the votes are already sitting with 3 firms whose default instinct is stability. A chief executive faces a shareholder revolt over pay. The same block decides whether the revolt succeeds. These outcomes are not decided in public. They are decided in the stewardship offices of 3 companies by teams most shareholders could not name. The individual saver whose money is involved almost never hears that any of it happened. The ballot was cast, the meeting adjourned, and the result was recorded, all far from the person whose retirement funded it.
The scholars gave this trajectory a name that captures the worry. Today, they call it the Big Three. If current trends continue for another 2 decades, they project, the same firms could cast up to 40% of the votes at S&P 500 companies by 2040. At that point, they write, the Big Three would become the Giant Three, and the phrase stops being a metaphor. But before we reach the future, we have to be precise about a fact that changes the entire meaning of this power. The money doing the voting does not belong to these firms at all. This is the detail that most reporting skips, and it flips the story. BlackRock, Vanguard, and State Street do not own the 22%. They manage it. The actual owners are the millions of people whose savings sit inside the funds. The school teacher with a pension, the engineer with a 401k, the retiree drawing down an index fund built over 40 years of work. The capital is deeply democratic. It is spread across most of the working population.
Yet ownership and control have come apart. When you buy an index fund, you get the economic returns, the dividends, and the growth. What you almost never get is the vote. That right travels up to the firm managing the fund, which votes on your behalf across every company the fund holds. You supply the money and bear the risk. Someone else decides how the shares that money bought will speak. It is a quiet trade almost no investor consciously agrees to. Buried in the design of the fund is a transfer of voice, from the many who own to the few who manage. And it happens the moment you click buy. Economists have a century-old name for this gap. In the 1930s, scholars described the separation of ownership and control, the way scattered shareholders lost real power to the managers who ran companies day to day. What is happening now is a second turn of that same screw. Ownership scattered across millions of savers has been reconcentrated, not back into the companies, but into the 3 intermediaries standing between the saver and the share. The firms are aware of how this looks, and they describe their role modestly. They call themselves stewards and fiduciaries, obligated to act in the financial interest of the people whose money they hold. In their telling, they are careful custodians, voting for long-term value, nothing more. That description is not dishonest, but it does not dissolve the underlying fact. A custodian of a quarter of the votes at every major company is a custodian with structural power, whatever their intention. The practical result is a strange kind of power without a face. There's no single owner to point to, no tycoon, no controlling family. There's a vast, faceless pool of ordinary people's savings, and there are 3 firms that turn that pool into votes. To see how that translation actually happens, you have to look at the machinery of the shareholder vote itself, and at the small teams who operate it. Every spring, public companies hold annual meetings. Shareholders vote on directors, on executive pay, on mergers, and on proposals that can reshape strategy. For the ordinary investor, these meetings are invisible. For the 3 firms, they are the moment their scale converts into influence. Across a single proxy season, the largest of the 3 votes at tens of thousands of company meetings around the world. That volume is handled not by armies, but by surprisingly small teams. Each firm runs a stewardship group, often numbering in the dozens rather than the hundreds, responsible for deciding how to vote billions of shares. They publish guidelines, meet with management, and issue their votes according to internal policy. A handful of professionals in each firm set the posture that will be applied, more or less uniformly, across the entire market. Efficiency demands standardization. Standardization concentrates judgment.
A single guideline document applied across an entire portfolio means that one policy choice ripples through thousands of companies in the same season. What looks like thousands of separate decisions is often one decision made once and repeated at scale. Because index funds hold companies permanently, the firms cannot express displeasure the ordinary way. An active investor who dislikes a company's direction simply sells. An index fund cannot sell. It must own the company as long as the company sits in the index. Its only lever is voice, the vote, and the private conversation with management. That constraint makes the vote unusually important because it is the main tool these permanent owners have. In practice, the three firms vote with company management the large majority of the time. They tend to support sitting boards, back proposed directors, and reject most outside challenges. Critics see deference that props up entrenched executives. The firms see disciplined support for long-term stability over short-term activism. Both readings can point to the same voting records because the raw fact is not in dispute. Three firms hold a decisive swing block, and they usually swing it toward the status quo. Now hold two facts side by side. First, the three cast around a quarter of the votes at nearly every major American company. Second, they usually vote with management. Put together, they describe a market where the largest voting bloc is also the most reliably supportive of incumbents. Whether that is prudent stewardship or quiet entrenchment is a judgment each viewer can make. But there is a sharper worry that goes beyond any single company, and it starts with a question about airline tickets. In 2014, three economists asked an uncomfortable question. Jose Azar, Martin Schmaltz, and Isabel Tiku looked at the American airline industry, where the same handful of large institutional investors were simultaneously among the biggest shareholders of United, American, Delta, and Southwest. These airlines are supposed to compete. But what happens to competition when the same owners sit behind all of them at once? Their answer, published in the Journal of Finance in 2018, was provocative. They found that on routes where common ownership was higher, airfares were higher too, by an estimated 3 to 11%, compared with what prices would have been if the airlines had separate owners. The mechanism they proposed was subtle. No one needed to collude in a back room. If the same investors profit whether United or Delta wins a given passenger, managers face weaker pressure to fight for market share on price. To measure it, the economists used a concentration index adjusted for common ownership and reported that on some routes, the implied increase in market power was roughly 10 times larger than the level antitrust authorities normally treat as a red flag. The theory has a name in academic work: horizontal shareholding, or common ownership. The claim is not that the three firms order airlines to raise prices. It is that when competitors share the same large owners, the ordinary hunger to undercut a rival may soften, because aggressive competition can shrink the combined profits their common owners collect. If true across many industries, the effect on consumers would be enormous, and almost entirely hidden inside prices. It is important to be precise because the finding is contested. The original airline study drew intense scrutiny, and later, researchers reanalyzed the same industry with different data and methods. Some, including a 2022 study, found no significant anti-competitive effect once the numbers were revisited. The debate remains unsettled among economists. What is not disputed is that the pattern the theory describes, the same owners sitting behind rival firms, is now the normal state of the American market. That is why regulators started paying attention. Antitrust law was built for a world of separate owners fighting for advantage. It was not designed for a world in which the same three firms are the largest shareholders of companies that are supposed to be at war with each other. The common ownership debate raised a possibility the law had never confronted, and it would eventually land in a federal courtroom. But first, there is a paradox at the heart of the three firms' business that makes the whole picture stranger. Here's the paradox. The three firms hold immense potential power over the companies they own, yet the very business model that made them huge gives them little reason to use that power actively. Bebchuk and Hurst call this the agency problem of index investing, and it cuts against the fear of an all-controlling puppet master. Think about the economics. An index fund competes almost entirely on price, driving fees towards zero.
Monitoring companies closely, researching board decisions, and fighting proxy battles all cost money. But any improvement those efforts produce raises the value of the whole index, which benefits every rival index fund equally, including the ones that spent nothing. A firm that invests heavily in oversight pays the full cost and shares the gains with competitors. The rational move is to spend as little on stewardship as the rules allow. It is the classic free rider problem, transplanted into the ownership of the entire economy. Careful monitoring is a public good among fund managers, and public goods are chronically underfunded because everyone would rather let someone else pay. That logic predicts under-engagement, not domination. It predicts firms that vote quickly, side with management by default, and avoid costly confrontations. And that, broadly, is what the research finds. Stewardship teams that are small relative to the trillions they oversee, and voting patterns that lean toward the path of least resistance. The danger, in this view, is not that the three firms micromanage the economy. It is that they are its largest owners and have a built-in incentive to be passive.
That may sound reassuring, but it carries its own risk. If the largest shareholders of nearly every major company are structurally disinclined to hold management accountable, then a crucial check on corporate power weakens. Executives who once feared activist owners can rely on a giant, stability-seeking bloc that rarely rocks the boat. Power that is not exercised can still shape behavior, simply by being predictable. So the concern splits into two opposite fears that coexist uneasily. One fear is that the three firms will use their votes too actively, steering whole industries. The other is that they will use them too passively, leaving corporate managers unchecked. Both cannot be fully true at once, but both point to the same root. Too much of the market's ownership now runs through too few hands, and one of those hands built something that extends its reach far beyond the votes it casts. Ownership is only part of BlackRock's footprint. The other part is a piece of software most people have never heard of. It is called Aladdin, short for Asset, Liability, and Debt and Derivative Investment Network. It began in the late 1980s as an internal risk management tool. Today, it is arguably the most important private system in global finance. Aladdin does not hold assets. It watches them. It models risk, runs scenarios, tracks portfolios, and tells institutions what might happen to their holdings if markets move. And it is not used only by BlackRock. Roughly 1,000 institutions, pension funds, insurers, banks, and rival asset managers run their portfolios on it. By some estimates, the total value of assets managed and monitored on the Aladdin platform runs above $20 trillion, a figure that has grown for years. Reporting around 2020 placed the number near $21.5 trillion, and later estimates push it higher still. The platform tracks tens of thousands of portfolios and runs millions of risk calculations a day across stocks, bonds, derivatives, and increasingly, private assets. Sit with that number. A single company's software, built and controlled by BlackRock, sits underneath a slice of the global financial system large enough to rival the assets the firm itself manages. It means that when markets convulse, a very large share of the world's professional investors may be looking at risk through the same lens, running similar models, and receiving similar signals about what to do next. That is a different kind of concentration than voting power, and in some ways, a more subtle one. Critics worry about what happens if everyone relies on the same risk model. If the model misjudges a danger, the error propagates everywhere at once. If it flashes the same warning to 1,000 institutions simultaneously, they may all rush for the same exit at the same moment, turning a wobble into a stampede. Shared infrastructure creates shared blind spots. BlackRock describes Aladdin as neutral plumbing, a service that makes the financial system safer by giving everyone better information about risk. That is a reasonable description of what it is designed to do. But it deepens the central theme of this story. The same firm that is among the largest shareholders of nearly every major company also operates the risk modeling backbone for much of the industry that invests in them. Reach of that kind does not stay confined to the private sector. Twice in recent memory, it extended directly into the machinery of the state. When the financial system nearly collapsed in 2008, the United States government faced a problem it was not equipped to handle. It suddenly held mountains of complex, toxic mortgage assets, and it needed someone who understood them well enough to manage and unwind them. The Federal Reserve and the Treasury turned to a private firm with unmatched expertise in exactly those instruments. They turned to BlackRock. The pattern repeated in the spring of 2020. As the pandemic froze markets, the Federal Reserve launched an emergency program to buy corporate bonds and stabilize the system. To design and run parts of that unprecedented intervention, it again hired BlackRock, a firm that also happened to sell many of the very bond funds the program would support. The government needed the best operator available at speed, and BlackRock was that operator. It also sat on both sides of the transaction. The firm helped decide which corporate bonds a public program would buy, in a market where it was itself one of the largest players. Officials pointed to disclosure rules and firewalls built to manage the conflict, and those safeguards were real. The optics remained impossible to miss. This is where the story moves from finance into governance. A private company was trusted with executing public policy at the center of two historic crises. It performed the role competently, by most accounts, and it built safeguards to manage conflicts. But the arrangement made unmistakable how far one firm's reach now extends. When the state needs to act inside the markets, it may find that the deepest expertise and the largest presence belongs to a company it does not control.
None of this requires bad intent to be significant. It is a structural fact about concentration. When capability and scale pool into a single institution, that institution becomes difficult to route around, even for a government. Officials described the hires as pragmatic necessity, and they were, but necessity that keeps pointing to the same firm is itself a measure of how central that firm has become. The blurring of public and private power did not go unnoticed. It fed a growing unease that these firms had grown too large, too connected, and too influential to be treated as ordinary companies. That unease might have stayed academic. Instead, BlackRock's chief executive walked directly into the center of a political storm, holding a set of letters that would turn the firm into a symbol for critics on every side. Every January, for several years, Larry Fink sent a letter. As head of the world's largest asset manager, he addressed the chief executives of the companies BlackRock owned. And the letters carried weight precisely because of the firm's size. Increasingly, they argued that businesses should account for long-term risks, including climate change, and that sustainability was becoming central to how capital would be allocated. Supporters called it responsible long-term thinking. It also announced, in plain view, that a firm holding a slice of nearly every company intended to have a point of view. That stance placed BlackRock at the heart of the fight over ESG, the practice of weighing environmental, social, and governance factors in investment. To one side, the three firms were not doing enough, using their enormous votes too timidly to push companies toward real change. To the other side, they were doing far too much, wielding trillions of other people's dollars to impose a political agenda on the economy through the back door of shareholder votes. The remarkable thing is that both critiques targeted the same underlying fact, the sheer scale of the three firms' influence. If they leaned into using their votes, they were unelected powers steering the market. If they held back, they were negligent giants ignoring risks to the savings they managed. There was no posture large enough to escape the contradiction, because the contradiction was baked into being that big. Power at that scale draws fire whichever way it moves. Fink eventually said he would stop using the word ESG, arguing it had become too politicized to be useful, even as the firm maintained it was simply managing risk for its clients. The retreat from the term did little to cool the anger. By then, the debate had left the pages of annual letters and entered the arena of elected officials, several of whom decided that voting power on this scale was no longer a matter for polite disagreement. What had been a theoretical worry among law professors, the idea that common ownership might distort competition and concentrate power, was about to be tested where theories become consequences. In late 2024, the argument moved into a federal court, and the specific battleground was not technology, or airlines, or banks. It was coal. In November 2024, the Attorney General of Texas, joined by 10 other states, filed a lawsuit against BlackRock, Vanguard, and State Street. The claim was among the most aggressive tests of the common ownership theory ever brought. The states argued that the three firms had used their large, overlapping stakes in competing coal companies to pressure the industry into cutting output, and that this violated federal antitrust law. The legal theory reached back to statutes written a century ago. The suit invoked Section 7 of the Clayton Act, which restricts acquisitions that may lessen competition, and Section 1 of the Sherman Act, which forbids agreements that restrain trade. In essence, the states argued that when the same firms are the dominant shareholders across rival coal producers and push them all in the same direction, the result can look like coordinated restraint of competition, even without a traditional conspiracy. It was the airline theory, now aimed at a courtroom. The firms denied wrongdoing and asked the court to throw the case out. They argued that they were passive investors managing index funds, that their engagement was ordinary stewardship, and that holding shares in multiple companies is exactly what index funds are built to do. In 2025, a federal judge in Texas largely rejected that request. He allowed most of the state's claims to proceed, letting the core allegation, that the firms collectively used their stock to lessen competition, move toward trial. The dispute drew in the federal antitrust agencies. The Department of Justice and the Federal Trade Commission filed a statement of interest, signaling that the government took the common ownership question seriously enough to weigh in on how the law should apply. Separately, Vanguard reached a settlement with Texas, agreeing to strengthen its commitments to remain a passive investor and to give clients more say in how their shares are voted. The state described the agreement as one of the most significant enforcement actions ever taken against coordinated shareholder pressure of this kind. One of the three had chosen to step back rather than fight, while the other two prepared to argue the theory in open court. Whatever the ultimate verdict, the case marked a turning point. A theory that lived for a decade in academic journals had become a live legal threat to the largest asset managers on the planet. The question was no longer only whether common ownership is good or bad for markets. It was whether the law, as written, can reach it at all. And the firms, reading the same signals, had already begun to change how they handled the single most sensitive part of their power: the vote. Faced with lawsuits, political pressure, and the simple discomfort of holding so much voting power, the three firms began to do something unusual. They started giving some of the votes back. If the core objection was that a handful of stewardship officers decided how trillions of dollars would vote, the response was to let the underlying investors decide for themselves. BlackRock led the visible push, expanding programs it branded as voting choice. Large institutional clients, and eventually a growing set of everyday investors in certain funds, were offered the option to direct how the shares behind their money would be voted, either by choosing from menus of voting policies or by voting directly. State Street built out similar options, and Vanguard, especially after its settlement, committed to widening investor choice as well. The message was consistent. This power does not have to be exercised from the center. The logic is genuinely appealing. If the deepest worry is the concentration of votes in three firms, then dispersing those votes back to millions of investors dissolves the problem at its root. Instead of three switchboards, you would have millions of individual decisions, which is closer to how ownership was supposed to work in the first place. In principle, voting choice turns the criticism into a feature. In practice, the effect so far is limited, and the reasons are human. Most ordinary investors do not want to study proxy ballots for hundreds of companies, and most do not participate even when offered the chance. Uptake has been modest. When investors decline to choose, the default often routes their votes back through the firm or through standardized policies, which means much of the concentrated power remains concentrated. The option to disperse is real. The dispersion, so far, is partial. Still, the direction of travel matters. For the first time, the three firms are acting as if the scale of their voting power is a liability to be managed rather than an asset to be guarded. That shift is a tacit acknowledgement of the central worry this whole story has been building toward. Because if the trend of the past 2 decades simply continues, the numbers point somewhere that no voluntary program may be able to contain. Return to the projection that gave this story its sharpest edge. Bebchuk and Hearst traced the three firms' combined voting power from roughly 13% in 2008 to around a quarter of the votes at major American companies today. Then they asked the obvious question: what if the same trend runs for another 20 years?
Their answer is that the big three could be casting up to 40% of the votes at S&P 500 companies by 2040. 40% is not a majority, but at that level, the distinction begins to lose meaning. In a world where most other shareholders are fragmented and passive, a bloc approaching half the votes is decisive on nearly any contested question. The scholars named the future state the Giant Three, and the renaming carries a warning. The gap between influence and control narrows until it is hard to see. This is what happens if nothing changes. The engine driving that growth is not ambition. It is the same automatic machinery from the start of this story. Every payday, contributions flow into retirement accounts. Much of that money lands in index funds. Index funds must buy more of every company. The three firms' stakes rise mechanically, without any decision to seek more power. The trend is built into how tens of millions of people save. Left alone, it does not plateau. It compounds. Each year's contributions add to last year's holdings, and the base that grows is already the largest in the market. Compounding is the same force that makes index investing so powerful for the saver. Pointed at ownership, it makes concentration almost self-propelling. There are forces that could bend the curve. Antitrust suits, like the Texas case, could impose limits. Regulators could cap voting power or require pass-through voting. Competition from newer, cheaper funds could erode the trio's dominance. Voting choice programs could disperse real power if participation ever rises. Each is plausible, none is guaranteed. The default path, the one that requires no one to do anything, still runs upward. That leaves a genuine question with no settled answer, which is exactly where a story like this should end, and where the moral judgment belongs to you, rather than to the narrator. A system was built to let ordinary people share in the growth of the whole economy, cheaply and sensibly. It worked. And in working, it gathered the ownership of that economy into three institutions that never sought to rule it. What you make of that outcome depends on a single question, which the final chapter puts as plainly as it can be put. Strip away the trillions, the acronyms, and the lawsuits, and one paradox remains. Ownership of the American economy has never been more democratic. Hundreds of millions of ordinary people, through pensions and retirement accounts, hold a real stake in the companies that shape their lives. That is a genuine achievement, and it was built largely by the very firms this video has scrutinized. The money at the base of the pyramid belongs to almost everyone. And yet the control attached to that ownership has never been more concentrated. The votes, the stewardship decisions, the engagement with management, and in one case, the risk software beneath the whole system, run through three firms. Diffuse ownership, funneled into narrow control. That is not a contradiction the three firms invented. It is the shape the market took when a good idea grew to enormous scale. They are the result of the pattern as much as its authors. Notice what is absent from this story. There is no villain, no secret meeting, no plan to seize the economy. There is a boring, brilliant financial product, the ordinary saving habits of tens of millions of people, and the relentless arithmetic of scale. That is what makes the outcome so difficult to argue about. You cannot point to a crime. You can only point to a structure and ask whether a structure this concentrated is one a healthy market and a healthy democracy should accept. The facts are not really in dispute. Three firms are the largest shareholders across most of corporate America. They cast around a quarter of the votes at major companies, a share that has climbed for 2 decades and may keep climbing. The money is ours, the control is theirs. Whether that is a triumph of accessible investing or a dangerous concentration of power is not a fact to be looked up. It is a judgment, and it is yours to make. If this is the kind of question you want followed all the way down, follow the channel, because the next investigation into who really holds power starts from exactly this kind of quiet arithmetic. Share this with someone who assumes no one owns everything, and tell us in the comments which hidden structure you want us to open up next. The names on the buildings change. The pattern rarely does. The only question left is who owns the future, and whether the answer should stay in 3 hands.